All right, so here's day 25 of my journey to a $500,000 stock market portfolio. So I did a lot of trades this week, so I want to go through my trades, explain why I did them. So first, let me start with calculating my equity. All right, so starting with my margin, got a total equity of 5285. And then in my TFSA, total equity of 57438. And in my RSP, 17118. So that gives me a total of 79841. So that doesn't look too good. I dropped from the 80s. All right, so in the last video, I talked about this earnings trade I did on Adobe. So I think I collected around $74. I ended up closing the trade the next day. Let me see if I can find it here. All right, there it is. So September 18, I ended up closing the trade for about $40. So after commissions, I was left with about $12 on the trade. So it wasn't a big amount, but I closed the trade because I don't want to take the risk of keeping it till expiration, which was September 20th, Friday. But if I had kept it till September 20th, I would have kept the $70 or $74 completely. I did not have to close it for $40. So I would have saved $40 plus commission if I had just kept it till expiration. But because there's always the risk of the stock moving, here let's look at Adobe in the last 5 days. So you can see after earnings, when earnings came out, it dropped hard. My limits, my boundaries, when I placed an iron condor trade was 267.5 and 300. So when it dropped hard, I wasn't worried about the 300, but I was worried about the 267.5. I don't know how far it's going to go. It ended up stopping at around 270, but then you could see that the next day it went all the way up to 284. So I'm still safe with my 300, but as you can see, anything can happen. So obviously I don't want to take the extra risk. The whole point of earnings trade is when earnings are released, there's a drop in volatility. So the premiums drop in value. So you can close out your trade for less than what you sold it for. So I did end up closing it for less, but it wasn't that. But I think I closed it at around, when the stock was trading at around 272, 273, because I started to panic when I saw it at 270. Just to show you that if I had kept it till the end of the expiration, which was on Friday, would have kept the full $74 because the range I picked was inside the final market price. So on September 19th, I also placed a put credit spread. I sold a put credit spread on Ulta. I don't even know if it's pronounced correctly, but the stock took a major drop recently. So if you look at the past month, you can see that it was trading at 337, but then it took a major drop down to 233, 236, and then 226, 230. So it's sort of trading horizontally around 230. The 52-week low is about 227. So I decided to sell a put credit spread expiring October 18. So October 18 at a 215 strike. So as long as Ulta stays above 215 come October 18, I keep my premium, which was about $80. So 220 minus 140. But my risk for this trade, so the max I can lose is the difference between $500 and $80. So the max I can lose on this trade is $420. But that happens if Ulta goes below 210. But I'll be watching this trade. As soon as it gets to, let's say, $160 or $200 of loss, then I'm going to close the trade early and maybe place another put credit spread a little bit lower. At the same time, if this put credit spread is worth $40, I'll close the trade early for a profit, a smaller profit, but I'll close it early so I don't have to worry about the risk. So that's the idea behind this trade, and basically the reason I placed it was because the stock took a major drop. So normally it's expected to come back up to its average trading price. Doesn't mean that for sure it's going to do that, and that it's not, and it doesn't mean that it cannot go lower, but that's basically the reason I placed this trade. And because there's defined risk, so my max loss is $420, I can still manage a trade. So if it starts to move lower, I can close it earlier for a smaller loss, and I can compensate for that loss by selling a put credit spread, let's say at 200 and 195. I also sold a put credit spread on Amazon expiring October 11 at a 1760 strike. But when I did that, Amazon was trading at 18.30 about. On Friday, Amazon dropped to almost close to that price. It dropped to 17. Here, let's see what it closed at. It closed at 17.82. So it's actually close to my put strike of 17.60. So if I have to, I could close this trade for a loss and then place another one a little bit lower. Or I can keep it and place another one a little bit lower, let's say at 16.95. If I have the assumption that this was just, the market in general on Friday dropped. So if I have the assumption that this is just something temporary, look at this chart here. Took a strong drop. So if this is something temporary, I don't have to worry about it. I have until October 11. I have 3 weeks. It's not hard for Amazon to come back up. It's got earnings, I believe, in the week of October 18. So I could keep it, or I can close it for a loss and sell another one a little bit lower. But as long as I'm watching it and managing it, I'm not too worried about it. I sold a call credit spread on Chipotle Mexican Grill, expiring October 11 at an 8.55 strike. So as long as Chipotle stays below 8.55 come October 11, I keep my full profit. Right now it's trading at 8.33. In the past month, you could see that it was at 8.56, then it took a major drop. Now it came back up to 8.33. I'm assuming that it's not going to come back up to 8.55. It's going to stay at this number or even come lower. That's my assumption. I could be wrong, but based on that, I went with an 8.55 strike. But like I said, I can always manage it. Look at the PE, 94. That's very high. If the trade starts going against me, depending on how I feel then, I could close it for a loss and maybe sell another one a little bit higher, or even add the put side to the credit spread to add more credit. So Netflix today dropped hard. So I already had an iron condor on Netflix, and as you can see, my put strike was 275. So Netflix today broke that strike completely. I think it reached all the way down to 265. So I ended up selling another. I kept this one because I think it's going to come back up. I ended up selling another put credit spread at a 255 strike on Netflix, which you could see over here. So 255, 250, October 11. Collected, I believe, $75 on that one with a $425 max risk. But for that to happen, Netflix has to go below 255. So my assumption is Netflix already dropped from, if you look at the past 3 months, it was trading at 380 before earnings. Then after earnings, it dropped all the way down to, I think, 320, and then slowly going down, and now all the way down to 267. I think it's had enough. I don't think it can drop anymore. That's my assumption. It could drop, but I think it's had enough. Although PE ratio is pretty high, maybe that's why the stock is dropping. Who knows? But it's got earnings coming out in end of October. We'll see what happens, but I want to get out of this trade before earnings come out for sure. But like I said, as long as I can manage the trade, if it starts going against me, then I'll just close it for a loss and then sell another one a little bit further. So this one right now is going against me. This one is trading at a loss. So I could close it and sell another one. Instead, I kept it and I sold another one. And the reason I kept it is because I do think that it might come back up, because I think it dropped hard today undeservingly. Could be just algorithms, who knows. So Roku took a hard drop as well today. I sold a put credit spread at an 85 strike, expiring October 18. So you can see Roku in the past month, let's say, it was trading at 169. Today it's trading at 106, closed at 107 about. So I sold a put credit spread because I don't think it's going to drop even more. So I sold a put credit spread at an 85 strike, collecting about, I think, $75 as well. So 224 minus 149. Yeah, so $75. So collected around $75 with a max risk of $425. But once again, as long as I manage it, I shouldn't have to be concerned. The only concern I have is if in one day the stock goes from 107 to $60, then I don't even have time to manage it. My credit spread will be trading for a big loss, but my max loss is $425. So as long as it moves gradually, even if it moves against me, but as long as it moves gradually against me, then I have time to manage it and either close it for a loss and then sell another one a little bit lower, or even sell a call credit spread if I think that it's not going to go above a certain price. So that's the advantage of doing credit spreads on ETFs that track the general market, like SPY or Qs or DIA or IWM, is because it's rare that you'll wake up and see the stock move from, let's say, from 200 to 175. An individual stock of a company can do that, but ETFs in general, they always move gradually, either up or down. I sold an iron condor today on DIA, so this ETF tracks the Dow Jones. I sold it expiring October 18. My strikes, 262 and 278. So the DIA was trading at 270. I went 8 points up and 8 points down. So 278 and 262 are my limits. And I collected about $112 on that trade. So as long as the DIA stays below 278 and above 262 come October 18, I keep the full $112. Or I could close the trade early if possible for half the profit. So DIA dropped actually today so I placed this trade when DIA was at 270, but it closed the day at 268.75. You can see today everything just took a major drop at around 1 p.m. Look at this straight line. The SPY, the Qs, everything just dropped hard and at exactly 1 p.m. Looks like it could be algorithms again. It's a straight line down. So I closed a lot of my positions in my TFSA to liquidate so I can have enough funds to do this one trade, which was a covered call trade on the Qs. So it's a little bit scary, 100 shares of the Qs, so about 19,000 US. The reason behind it, I explain it in my other videos, is I'm tired of doing covered calls on stocks. And for example, I end up buying a stock. Let's look at Afria here. I bought it at 12. I bought it at 11.73 and it's trading at 8.15, which makes it hard for me to sell a call option the following month. So the first month when I initially place the trade, I'm fine. But when the expiration of the option comes around and the stock is trading at $8 when I bought it at 11.73, I can no longer sell a call option at 12 unless I go a few months out. But then that defies my purpose of trying to make 2 to 4% per month. So I had to go probably 3 months out just to collect $25. So that's the idea. I've got another one, Bed Bath & Beyond. Bought it at 14 initially, and then the stock dropped to $7. So it's been happening a lot. Grubhub as well. Bought it at 70. Look, it's trading at 59 right now. Teva is a really big one actually. I bought it initially at 18.5, but an average price of 15. Right now it's trading at 7.45. So that's why I want to stick to ETFs that track the general market. So something like the Qs, yes, it is a lot of money, but it's safer than all these stocks individually because the Qs is comprised of the biggest stocks in the Nasdaq. So Microsoft, Apple, Facebook, Intel, all the big names that I'd be comfortable buying individually. The Q is comprised of all these. So really, it's safer to buy the Qs than all the other stocks individually. And the idea behind it is I'm going to sell weekly call options on it. So for example, bought it at 191. The stock dropped a little bit, not a lot, but I sold at a 191 strike expiring September 27th. So 1 week out, collected $150. So that's about 0.8% per week. But if you annualize that, that's about 41%. Obviously, that's if I can get 0.8% every week. But now let's say the stock goes up. If it goes past 191, then I get my money back. I collected my premium already. Then I could do the same thing. I could buy the Qs back wherever it's trading at it. If it's at 192, I buy back on 192 and sell a call option at a 192 strike. But let's say I as you can see, I already bought it at 191, but then let's say it drops next week to 188, 187, let's say. So now, of course, if I can, I'll stick to a 191 strike, collect whatever I can collect 1 week out. So let's say the stock drops 4 points. If I stick to a 191 strike the next time I want to sell a call option, I'm going to collect a smaller premium. This time I collected $150. Next time I won't be collecting $150. I'll collect probably around, let's say I go to 195 just to simulate the ETF dropping 4 points. So 4 points higher, I'd collect about $16 or $17. So that's not a lot, of course, especially compared to $150, but it's still something, and it's only 1 week out until I wait for the stock to come back up. And because the Qs represent the general market and the general market goes up over time, I'm not concerned about that. I know that eventually it'll come back up unless we go through a crash. But let's say we go through a crash. So let's say the stock, so I bought at 191, let's say it's trading at 150 next week, or a few months later it's trading at 150. So of course, I'm not going to sell at a 191 strike because I won't collect any premium. But what I could do is because I have weekly expirations, if the stock's trading at 150, I could sell a strike at 155 or 160 because I only have 1 week to go. So I'm not too worried that the Qs will go from 150 to 160 in 1 week. So by selling a call option at a 160 strike while the stock is trading at 150, even if my purchase is 191, I'm going to still collect an okay premium at a 160 strike. So I'm still generating income from this position. And I'm not worried of losing my stock at 160 when my cost is 190, because in 1 week, it's unlikely that the Qs will go from 150 to 160. And if the Qs are trading at 150, that means volatility is high because the market just dropped. So the premiums are going to be worth more. So by selling something at 160, even though it's 10 points higher than the current market price, premiums might be worth it. So that's the idea behind this trade, is to generate income from my capital. How can I make my capital generate income for me every week? So in this example, the capital is about 19,000, and for the first week it generated 150. Then we'll see what happens next week or the week after, because this basically covers the following week, the upcoming week. The reason why I want to stay away from stocks in terms of covered calls is because, as you could see here, I had to take a 9 strike just to collect 6 cents on Teva. Now I got lucky. My cost is an average price of 15. I got lucky because Teva did not end up surpassing a 9 strike, but that doesn't always happen. I've got positions where, for example, Halliburton, my cost is 23. Halliburton was trading at 17 or 18, so I ended up selling a call option at a 20 strike. So today I had to buy it back. I think I paid like 35 cents to buy it back, and then I sold a 23 call option. In certain cases, the stock might surpass your strike, and then you're forced to buy it back if you don't want to lose your shares at a lower strike. Wow, the Qs dropped to 190.4 after hours. Not cool. But let's look at the Qs, let's say 1 year out. So you can see in December it took the major drop, but immediately it recovered. And in May it dropped again, but then it recovers again. So let's say I bought it high, which I think I did. And it does take a drop. It looks like it wants to drop. I mean, it always drops after it goes a bit high. So we're expecting a drop next week. But I know that if it's not a recession, if we're not going to crash, it's going to come back up. Over time, it always goes up. 5 years, always goes up. So just general market direction always goes up. And you can see the margin requirement on the Qs is only 20%, while other stocks it's 30%. So by holding this in my TFSA, it actually gives me more buying power in my margin account. And what I plan to do with my margin account is to continue selling credit spreads. So you could see that my maintenance excess in my margin account is about 22,000. So that comes from my TFSA holdings. Now I have to be careful because it's linked to my TFSA. So if my TFSA drops, the maintenance excess will drop, and then Questrade might start liquidating my positions in my TFSA. So just because I have the buying power doesn't mean that I have to use all of it, but I could use a bit more. So I still got some covered calls in my margin account, Zillow, United States Steel. So here's another bad example. Average price of this stock is 18.29. Stock is trading at 10.81 now. I got lucky. I sold at a 13 strike and ended up staying below 13. But that's not going to always happen. But Weight Watchers is an example where I ended up losing my shares at 25, while my cost was about 28.5. I've got Uber. There's another example, bought at 40. Stock is trading at 32. But the rest are credit spreads. So Ulta is a credit spread. Tesla is an iron condor. Tesla is showing a small profit. SPX is an iron condor. SNC is a covered call. Shopify is an iron condor that's getting tested on the put side. My limits are 300 and 400, and as you can see, it's trading at 317, but I still have until October 18, so I still have time. And then all the rest are credit spreads except for Dell. It's a covered call trade, which is doing well for me. I'm always collecting a decent premium. So for October 18, I ended up collecting $187 over a 52.5 strike. So 1.87 divided by 52.5, 3.5%, which is perfect. Box as well is a covered call trade and American Airlines, but as you can see, it's a 31.5 and the stock is trading at 28. So it's going to be a small premium, but it expires October 4th. So that's why I want to stop doing covered calls on stocks. I want to stick to covered calls on ETFs like the SPY, the Qs, and IWM, or even EWZ, and then credit spreads on everything else. Alright, so this was a quick overview of my trades this week. If you have any questions, any suggestions, please leave them in the comment section below. I'm open to all feedback. And like always, if you're going to open an account with Questrade to trade on the stock market, use my referral code in the description below the video to get up to $250 back. Thanks for watching.